In this video, I'm going to explain how some of the best performing hedge funds over the past 30 years have been able to protect their investments by using a framework called the all-weather portfolio. By the end of this short video, you will be able to apply the same framework to your investments in order to best protect them and ensure that they continue to grow. One common misconception that most people have about investing is that by minimizing the risk, you minimize the possible upside. No risk, no reward, right? Now, this is true in certain cases, but in the all-weather portfolio, I'm about to show you how we minimize risk without limiting our upside. I'll put the links in the description to some of the more nitty-gritty calculations, but to keep it high level, the all-weather portfolio has a majorly reduced downside when compared to investing with the overall stock market. For example, in 2008, which is one of the worst years for our US economy, the S&P 500 was down 37%, while the all-weather portfolio was only down by 3.7%. Can you believe that? Only 3.7%. So the all-weather portfolio works by having different buckets of asset types with assigned percentages. And when the value of these buckets goes above their percentage, then money will flow out of them into the rest of the buckets, causing us to sell high. And on the opposite, when a bucket goes down in value, we will pour out money from the other buckets into the low bucket, causing us to buy low. Now, this act of rebalancing is very important because it forces us to buy low and sell high instead of the opposite, which usually happens when I'm trading on my own intuition. When a stock, for example, is going up, I have a tendency to buy more because I think that it will continue to go up, but in fact, it usually comes back down after I buy. And on the other hand, when I see a stock falling, I assume that it's going to crash and I will sell. And usually it will bottom out and come back up. And so this act of rebalancing forces us to buy at the bottom, usually, and sell at the top. And in addition to that, I use Wealthfront, which does all of my rebalancing automatically. And as a result, I am a lot less tempted to look at the individual assets and make a bad buying or selling decision. In addition to being diversified across investment type, stocks, bonds, crypto, for example, the all-weather portfolio is also diversified across time. It's diversified across industry, meaning not all the money is invested in the auto industry. And it's diversified across geography, meaning that not all the money is in one location or one country. To diversify geographically, it is okay to have most of our investments in the US and European markets, but at the same time, we still want to have some of our money invested in other countries like India, South Korea, the Emirates. And the reason for this is because the markets and economies of these countries tend to move up and down in value independently of each other, which increases the rebalancing effect that we discussed earlier. Also, in times like these where we have global conflict or certain geopolitical issues, being spread out geographically can protect us from certain wars or other situations that happen in certain parts of the world. And in the same way, we want to spread our money across different industries so that we aren't overly affected if a single industry collapses. Some of the industries that I've spread my money across are banking, oil and gas, auto, and batteries. Also, I have a large portion of my stock investing sitting in index funds, which are generally pretty diversified across industry, unless, of course, these are industry-specific index funds. Okay, so we've talked about diversifying across geography and across industry, and the third way that we can diversify our all-weather portfolio is across time. And the way that we can do this is simply by not investing all of our money at one time. For most people like myself, this is not hard to do as we don't have big lumps of money lying around that we want to invest. But by putting in money a little bit over time, it protects us from any short term market movements up or down. For example, in the 2 years that I have had a Roth IRA, if I had put in all of my money at the beginning, I would be down by 20% right now. But because I put in little bits of money every single week, I am only down by 2%. And the reason it's only gone down 2% is because when the overall value of our portfolio goes down, when we're putting in money as it's going down, we're technically getting everything on sale. So that when the account even goes back to zero, we've gotten a lot of gains instead of just having the original investment start as zero and go back to zero. So to recap, we can protect our retirement and investment accounts by diversifying across investment type, geography, industry, and time. However, while unforeseen events or conflicts might threaten our life savings, the best way to protect ourselves financially is to increase our income. The reason for this is that it's so much more difficult for the world to take away our skills than just to take away our money. If you want to learn the best and the quickest way to get a raise, click on this video.